In this example video, I'm going to demonstrate review exercise 3.7 and review exercise 3.8. So we're going to be looking at putting together an income statement and doing the closing entries at the end of a company's fiscal year. So they give us the information dealing with Goldfinger Corporation, and they said at the end of the year they had sales revenue of $29,000, cost of goods sold of $12,000, operating expenses, which would include all your selling, general, and administrative expenses that are associated with running and operating your business at $6,200. And they also give you your income tax expense of $4,320. They tell us to assume that there was 4,000 shares of their common stock outstanding during the year, and they want us to put together their income statement. So we start with our sales of $29,000. We're going to take away from that our cost of goods sold of $12,000, which gets us our first subtotal under the multi-step income statement of gross profit of $17,000. Our operating expenses, all those expenses, again, keeping our business running and operating, come next. And we subtotal those to get to our income before income taxes. And they told us this year we'd have to pay $4,320 in income tax expense. So that tells us at the end of our fiscal year, we have net income of $6,480. We have earnings per share of $1.62. Again, how we calculate that is we take our net income in total, in this case, $6,480, and we divide it by how many shares of common stock have been outstanding during the period. So 4,000 shares. So $6,480 in net income divided by 4,000 shares of common stock outstanding gets us our earnings per share calculation of $1.62. They also wanted us to do our closing entries. And I gave you a little reminder over here about the accounts that have to be closed. Every company does this a little bit differently in terms of whether or not they use what an account called income summary or not. So depending on when you took financial accounting and whether or not you took it with us, you might have used an income summary account in financial accounting, you might not have. So accounts to be closed are RE3, revenues, expenses, income summary, and either dividends if you're dealing with a corporation or the owner's drawing accounts if you're dealing with a sole proprietorship or partnership. So we close out those accounts, revenues, expenses, income summary, and dividends, because those are our temporary accounts, meaning that they only capture information for a 1-year time frame. And then we close out those accounts at the end of the year by setting their balances to 0 in our ledger and starting all over again in the next year. Again, little reminder for you if you're having trouble remembering, if it's been a while since you took financial accounting or summer kind of erased your memory of debits and credits, if you kind of make yourself this little T-chart, and after eating dinner, let's read something exciting. The A in after, the E in eating, and the D in dinner stand for assets, expenses, and dividends. And those are the types of accounts that we have that increase with the debit. On the other side, the L stands for liabilities, the R stands for revenues, and something exciting stands for stockholder equity. So we're thinking about common stock and preferred stock and retained earnings. Those are all those stockholder equity accounts that we're talking about. Those all increase with credits. So kind of a little quick refresher for you regarding debits and credits and how each type of account increases. So we want to close out at the end of our company's fiscal year. We only do that close process one time a year. We want to close out those temporary accounts. Again, if income summary is new to you, what we're talking about with income summary is exactly what it says. It's summarizing your income, meaning it's summarizing what happened on your income statement. So what's on our income statement? Our revenues and expenses. So these two classifications of accounts are actually going to be closed out to our income summary account. So if we go back over here, we're going to start with our revenues. So we know our revenues increase with a credit. So if we want to bring their balance down to 0, we want to close it out, we're going to do the exact opposite to that account, and we are going to debit it for the full balance, in this case, the $29,000. Revenues are on our income statement, so they're going to get closed out to income summary of 29,000. So I made a little T-chart over here for income summary. We know debits on our left, credits on our right. So what just happened is that we credited it for 29,000, representing our revenues. We're now going to close out our expenses. Our expenses, we know, increase with a debit. So if we want to decrease them, we're going to credit each one of those. Expenses are on our income statement, so we are going to close those out to income summary, and we'll get back to that value in a moment. So thinking about our expenses, we had cost of our goods sold, and our cost of goods sold was $12,000. We also had our operating expenses of $6,200, and we had our income tax expense of $4,320. We know our debits and credits have to equal, so we simply sum up the total of our expenses to get how much we're going to debit income summary for. So we are going to debit income summary for $22,520, representing our expenses. So when we think about it, we know that when we're looking at a ledger, in this case a very small T account, we know credits and debits, when they're opposites, we subtract. So in this case, we have a credit of 29,000. We have a debit of 22,520. When we subtract the two, we know our credit side is larger. So we're going to have a credit balance of $6,480, which represents our net income. So it essentially, again, has summarized our income statement. It has our revenues, all of our expenses, and we're left with the net income value. So revenues, expenses, the difference is either net income or net loss. Income summary is also a temporary account. It's only ever used during the closing process, and we have to actually close out that account as well. So if it has a credit balance of $6,480 and we want to make it zero, we're going to have to debit that account to close it out. So we are going to debit income summary for $6,480. Net income gets carried into and affects our retained earnings account. And when it's a net income, it adds value to retained earnings. Retained earnings is a stockholder equity account, which means that it increases with a credit. So exactly what we're going to do here is we are going to credit our retained earnings for the $6,480, representing that the net income has been transferred into a permanent account that then gets pulled into, as we know, our balance sheet.